Rate cuts may precipitate a stock market crash. A comprehensive analysis by C.L. Roberts. Central banks, including the Federal Reserve, utilize interest rate adjustments as a pivotal mechanism to steer economic activity. The implementation of rate cuts is intended to reduce borrowing costs, thereby stimulating spending and investment through improved loan accessibility. While the anticipation of rate cuts can lead to stock market rallies, historical evidence suggests that the actual enactment of rate cuts often leads to market contractions. On average, the stock market has retracted by 23% following the initiation of rate cuts. This counterintuitive outcome highlights the intricate nature of investor psychology, where initial enthusiasm about lower borrowing costs is eventually eclipsed by the grim economic conditions that necessitate such cuts, such as slowed growth or impending recessionary pressures. Transitioning investments from equities to real assets. In a climate of falling interest rates, a notable shift occurs in investment strategies, with investors moving from liquid assets like stocks to more tangible assets, particularly real estate. This shift is driven by the increased affordability of loans, which enhances the appeal of property investments. As traditional safe haven investments like savings accounts and bonds offer lower returns, investors are drawn to the real estate market, which may experience a surge due to this capital reallocation. The role of inflation in investment decisions. Inflation significantly impacts the value of currency and investment choices. High inflation diminishes purchasing power, making cash and cash-equivalent holdings less attractive. In contrast, during deflationary periods, the relative stability of cash encourages a more conservative investment approach, with preferences shifting towards assets that safeguard against inflation, such as Treasury inflation-protected securities, TIPS, or real estate. Navigating inflationary pressures with liquid assets. As inflation rises, the devaluation of cash prompts investors to seek assets that can outpace inflationary pressures, often leading to an increased investment in equities. These assets offer the potential for returns that exceed inflation, which can result in a boost to the stock market due to the redirected flow of investments. Interest rate reductions are crafted to rejuvenate the economy by alleviating the financial load of borrowing. However, they also signal underlying economic challenges that could negatively impact the stock market. The reallocation of capital from liquid to hard assets can lead to market volatility, and the valuation of cash, along with the attractiveness of various investment options, is deeply influenced by inflationary trends. Investors must thoroughly understand these interconnected elements to navigate the complexities and opportunities presented by changes in interest rates and inflation.